Hi guys, this is Bill Black with Northwest Funding Group. I want to go over my weekly newsletter that I'm trying to get published, pushing out a little bit of video, maybe a little bit of me going over it might help a little bit. So I'm going to start out moving forward. A lot of people have been asking me to send them weekly kind of a market analysis of rates. So this here is coming from another service that I use called Mortgage Coach, and it kind of gives an idea of the 30-day range of where rates are at. And again, every lender is a little different. Some charges points, some don't. So this isn't an exact APR in here, so it's pretty much given a range. Okay, so don't hold me against these rates here, but I mean this is pretty much where I'm at today. About seven. I just locked one yesterday, 7.411, and so with no points on that. So 30-year 7.409, jumbo a little bit higher, FHA a little bit lower, but you have that upfront mortgage insurance of 1.75, and then you have monthly mortgage insurance of 0.55% on the FHA, no matter what you do with that. Usually, this is my 680, maybe 700 and below people, and then or people with a bankruptcy in the past, Chapter 13 that they might be just have on time payments with. So this is kind of a little bit of a bump in the road that we kind of most likely going to refinance out in the future. Our VA, actually, we're down. I think I just saw the lock rate this morning at 6.99 on one of those USDA, and then the 15-year conforming. This right here shows the impact of if you had a lower credit score on a LTV over 80%, you're actually going to be paying higher. And then how improved credit scores will improve your rates here. So then what this shows is kind of we came off of the spikes. The blue is the jumbo. This is the 30-year conforming. We kind of came off the bottom lows and we kind of bouncing back. The things are stable now. As of today, they're getting better again. And so because of the CPI numbers are improving. Want to always highlight a program as a mortgage broker. Today, I hit the 10 ways to qualify without tax returns. That would be using 12 or 24 months of your bank statements, personal bank statements, and this is for self-employed people. A debt service cover ratio, we can usually go to about 1.0, even lower with good credit scores and some money down. Usually about 25% down is where this comes in at. And then we can use 1099 statements. All of this will replace the need for a tax returns. Asset depletion, I have a little typo in there. So this means if you have $1 million worth of stock, we're going to take $750,000 divided by 360, and that's going to be your income that we'd use for qualifying with asset depletion loans. We can use 12 or 24 months of P&L statements. If we use straight W-2, we're still not going to need tax returns as long as you have pay stub, VOE, and then the W-2 transcripts showing that W-2 existed. And then instead of the Schedule E of tax returns, we're going to use lease agreements and proof of rents paid with the W-2 income for that. We'll utilize IRA or trust income documentation. Typically, you need a history of about 2 years showing that money is coming out. If you just started, there might be some exceptions to make that work. If you just started about a year ago, there's a large money in your trust. We know that you're going to be getting a certain amount. We can utilize that income and not need tax returns. Real estate investors with less than 10 units are eligible under full doc, and that we would be basically anything more than 10 is going to go bank statements for that. Retirement, Social Security, annuity, or pension income is acceptable without tax returns. We just need an award letter and the benefit statement, and or a most recent 1099. We can combine all of those and get really creative with this. So basically, if you're self-employed, you're an Uber driver and multiple different side hustles, and you got 10, 15, 20, 25% down to buy purchase a home or buy a flip or something like that, let's reach out and talk and put a plan together. So just going over the week in review, home prices continue to hit highs. We've seen that this is five different reporting companies. Some of them utilize cash buyers, some of them don't. They're all a little different. So we try to take all of them and then get a range in between these. We can see every month we have an appreciation typically has been happening all year. That's because houses are not selling. The inventory is so low. People want those 2.5%, 3.5% rates. This is why assumable programs are just freaking going to kill it for us. So we got a whole program started on buying and selling assumable properties. So more on that later. So the year over year, you see anywhere from 2.6 down to 2.1. But as the continues to go onto this pace, we're looking at anywhere between 6, 7, 8, 7, 6. So I would say about, between these, you're probably about a 6.5% appreciation on homes year in 2023, which everybody said it was going to be the year of a crash when rates hit 8%. So low inventory is what's keeping the stability there. As we kind of go through, you can read through some of the information around that. Continuous job claims continue 7th straight week. This is an upstream identification that the jobs are going down. Income is starting to stabilize and go down. And so, the party's over. Time to sober up and on the recovery mode. And then we talk about the recession. I believe we're in a recession. We'll probably see it actually in the news first quarter. By then, the Feds will start lowering rates, and we should have a pretty soft landing, hopefully. And then what to look for, the CPI numbers came out. They look pretty stable. Actually, that's what gave us a boost yesterday, Monday. Today's Tuesday, kind of late getting this out. So, and then the crypto, we basically see an improvement of that. We see the Bitcoin is doing really well, and kind of the bears are waking up. And as we continue to have issues with our economy, I think that it's a good time to be slowly buying into some crypto myself long term. So again, Bill Black with Northwest Funding Group. Just wanted to go over today, and I do feel that we are heading toward that light at the end of the tunnel, and the recovery's down the road. One thing is that today we might have a 7.25%, 7.5% rate, and we might be paying a $500,000 home. But when rates drop down to 6.5%, we're going to have, it's like going to Disneyland right now with no lines, or waiting until spring break when the buses are lining up. You're going to pay $20,000 over asking. If you're a first-time home buyer, it's going to be more of a challenge. So, put a plan together to buy when there's no lines, and that will help you be able to not to win a home for one, and not have to compete with these cash buyers that's going to come out of the woodwork in the future. So, any questions? Bill Black, and I am at billcblack.com, or you can reach out to me at any of my social pages. Thank you. Have a great day.